Welcome back. Module 9 Technical Analysis. So, as part of Module 5 Investment Analysis, we have seen Fundamental Analysis, Macro, Fundamental Analysis, Micro, Qualitative, Micro Analysis, Quantitative, then Golden Rule of Investing. Now, we are going to discuss about Technical Analysis. So, again our contact details and other details are given. Target audience, slight change in the target audience. Let me read out what the target audience is. Any graduate, of course graduates can learn anything, there is no restriction on that. Apart from that, BBA, MBA, CA, CFA students, which we have given earlier also, house managers obviously, anyone interested in enhancing banking and finance knowledge, that is the common, but anyone interested in basics of technical analysis. Why? Because up to now, till module 8 is more than sufficient for you to be a fundamental investor. If you want to slowly move into a trader or you want to time the entry and exit, you have to learn technical analysis. Fundamental analysis will not tell you the right entry and exit time. Hence, basics of technical analysis, if someone is interested, it is for them. Hence, that is why we have included that. What is the takeaway? Basic understanding of technical analysis, basic understanding, please understand that it is going to be only basics. Combine the power of fundamental and technical analysis. So, now up to now you have learned fundamental analysis, now you learn technical analysis, you combine both and you become a very effective trader. So, once again I put the basic slide, investment analysis. What is investment analysis? We have seen fundamental analysis, left hand side, everything extensively we covered. Right hand side, what is there? Technical analysis. Technical analysis, I stated earlier, again I am repeating, technical analysis is the study of human emotions, identifying good entry and exit opportunity with or without doing fundamental analysis. So, as you can understand, up to module 5, 6, 7, 8 you can do or you need not do, straight away you can go to technical, but that will not make you a comprehensive trader or investor. So, hence knowing that is very important, but doing technical analysis you need not do a fundamental analysis because already it is done, right. So, always I state this, market does not move on the basis of fundamental analysis, but on the perception of market players. Perception is nothing but mood of the market, which is nothing but demand and supply, that is accurately captured by technical analysis. That is what it is. Now, let us go into technical analysis. What are the key parameters, basics of technical analysis? Price volume pattern, that is very important. So, normally when a stock moves up, if it moves up normally it does not say anything, but when it goes up or again when it goes down also it is the same thing. When it goes up or goes down with higher volume, that means what it tells? It tells that more people are ready to come and buy, and that is why the volume is increasing. There is a sudden surge in the demand. So, again technical analysis is very simple. Of course, finance itself is very simple. Demand and supply, if you understand that logic, it is very easy. So, when there is sudden surge in volume, when the price is going up or price is going down, then that means people are more buyers are coming even the price is going up, or more sellers are coming even when the price is going down. That means price volume is an important element in the technical analysis. Then percentage of traded versus delivered, delivery versus traded. So, you remember what is trading, what is settlement. If you recollect, all trades will end in settlement, that is what you have seen. Okay, in module 5, right, basics of trading and settlement in module 4, we saw that, right. But 9:15 to 3:30, the same person who can buy can sell in the evening, or morning he can sell and evening he can buy and square off the transaction, and that will not end in settlement because he is a buyer, he is a seller, he will get only the differential or he has to pay the differential, that is the profit or loss. So, whatever is trading, all the open position that will be settled, that will be taken for settlement obligation and which will be settled. So, what is the delivery percentage increasing as a percentage of traded? That reflects that more people want to have a long term ownership, that means they want to take delivery and hold it long term. So, that reflects the confidence on the company. Then support and resistance. Support and resistance are very, very important. What is support? What is resistance? This is support, this is resistance. Any stock, when it is hovering here, it can, once it goes down here, what happens? People who have missed the bus last time, now they will come and create demand at the price, because all the information is available in the public domain. I always say this, stock market is the only market I know in India which is a fair market. Fair means free market. Free means both demand and supply operates perfectly without any intervention. That means all the people have all the information at the same time. So, everyone in the market, every player knows that this particular stock last time, let us say for example, when it came down to now it is at 38. Earlier it came down to 35 and then it jumped up again. So, those who missed the bus last time in buying when it was 35 will come and create demand. So, when it now next time comes at 35, people will start buying, creating demand, and the price will shoot up. Suppose last time it went up to 45 and after 45 it started falling and coming back again. So, people will know this information because it is all available in the public domain. So, when it again touches 45, there will be more sellers who will be coming and creating selling pressure, and the price will start falling. So, that demand, support and resistance are very important, and as a trader you need to carefully identify the support and resistance. Sometimes the support, it is broken, it will act as a resistance, and resistance, it is broken, will act as a support. So, that is also very important. Then next is moving averages. There are certain moving averages which are important and few are very, very important. 20 day, 30 day, 50, 100, 150 and 200. There are many moving averages. I mean, you can put thousands of moving averages, but these are some of the moving averages, standard moving averages that people use. So, out of which 200 day and 50 day are very, very important. Why? Institution, large players, they commit funds or they buy when a stock is above 200 day moving averages or about to break the 200 day moving average. That is why many times we have seen stocks nearing the 200 day moving average, either it breaks from there and falls if it is going up, or if it breaks, it goes up decisively, and you can see another good percentage of 3 to 5% of movement happening in those stocks when there is a breakout happening. We call it as a breakout. So, 200 day moving average is very important. Likewise, institutions and big players consider 50 day moving average in a shorter time frame. Why? 200 day moving average is simple. Every day closing price for the last 200 days is taken and divided by 200. 50 day is for a 50. So, that is for a shorter time period, 200 days for a 200 day moving average. Then there is of course 20 day moving average is also very important, which we will see, which will not be covered here. Exponential moving averages. So, there are certain exponential moving averages that are also very important. So, people use 20 exponential moving average, some people use 20 week exponential moving average, 20 month exponential moving average. So, or even some people use 21 days exponential moving average, so many things. I mean, one can define their own methodologies, but conceptually we have to understand all these things play a significant role, because it is after all human psychology. Corrections, then market corrects itself. The corrections can be two things. One is that price correction, other is the time correction. What is price correction? Price falling down, or when the price has fallen down, it is price going up. A further fall is not happening or further rise is not happening. So, that is what we call it as price correction. So, that is why many times investors lament, they say, no, I bought, the price has started falling down. That is called price correction. Sometimes we have heard people saying that I bought this house 5 years back, or this apartment, it is not at all increasing. What is it called? It is called time correction. The price is not falling, but with the time it is quoting at the same price. That means it is, we call it as time correction. Why? Because due to inflation, the purchase power of rupee is coming down, but after 5 years also the value of the asset is not going up. This we call it as time correction. So, normally in stock market, any sideways movement we call it as time correction. Then trend reversal and breakouts, which we said, right. Normally any breakdown above the 200 day moving average or below the 200 day moving average decisively, please note the word decisively. So, you will see a real breakout. Sometimes it can be a false breakout. It will break out to trap the bulls or bears at the respective side when it breaks out, and then it goes in the direction in which it was originally going up or going down. So, one has to identify what is false breakout, what is real breakout. Of course, it comes with experience. Of course, this is, as I said, it is only basics. Then there are popular chart types. The most two important thing is the line chart and the candlesticks. Bar chart is also some people use. Bar and candle are one and the same. Okay, line chart and candlesticks. We will see next slide. We will go. We will see what is. I will explain what is line chart and bar chart, and then we will go and show some examples. Line chart. Line chart is nothing but all the closing price of stocks every day. Let us say, for example, December 15th closing price, December 16th closing price, that is plotted and it is charted like this. It is charted like this, right? So, I will show that example next slide. So, that is called line chart. Bar chart is nothing but the opening and closing, opening up and closing down, and the high and low is marked. So, candlesticks, I will explain candlesticks, then I will go to bar chart. So, what happens? Typically, in any fair market or free market, that is, buyers and sellers have informed decision, there are 4 price points that happen. What are the 4 price points? One is the open price for the day, then close price for the day, then high price for the day and low price for the day. I am using the word day, but it does not mean that it is only for day. It can be for any time frame. It can be for, in stock markets we use it for 5 minutes, 15 minutes and various time frames. In any other commodities, in real time vegetables or anything, you can use day, week, month or any time frame you want, right. So, any time frame you can use, it will work perfectly. So, these 4 price points are available: open price, high, low and close. Candlesticks are used to denote the 4 price points. The bar chart also denotes the 4 price points without closing the notch. We will see the example here. The line chart, as I told you, as you can see on the left hand side, line chart, on the right hand side you can see the bar chart, right. You are able to see the difference, right. Let me go to the next slide. So, as you can see in the line chart, it is just a line. The closing price alone is spotted. Whereas on the right hand side, you see the bar chart. If you see closely, there is a open, there is a 4 notch and high and low, right? 4 notch high and low, and that is shown. See the candlesticks here. Candlesticks, bar chart and candlesticks. You see the next slide, slide 7, type of chart, candlesticks. You see the bar chart and candle chart. I have shown here. If you see here on the bar charts, candlesticks we will see first. You see here the green candle, open, close, high and low. Red candle, open is higher, close is lower. So, high and low. Only thing in the bar chart is that the notch, we do not form like a candle. It is shown on the open on the left hand side and close on the right hand side. If close is lower and open is higher, open on the left hand side and close on the right hand side. The high of the bar and it is not shown by anything. It is shown by a wick. Whereas candle, as you typically see in a candle, you have a body and you have a wick, upper wick and lower wick. That is candlesticks chart. So, this is the basics of technical analysis. In the next module, we will be discussing extensively about the basics of candlesticks. So, I am sure that you will be waiting for the next module. Thank you very much.